Welcome to the Property Code. I am your host, Nick, and today we explore a question that fills search bars from coast to coast. What delivers better results, the stock market or real estate, and how do their returns really compare in the landscape of 2025? The rising popularity of phrases like stock and share market difference, return on investment in real estate, how much return to expect from stock market, and why real estate is the best investment shows just how many people are wrestling with this puzzle. To bring theory to life, let me introduce two friends, Grant and Denise, who took very different wealth-building paths after graduating together in 2019. Grant dove headfirst into equities. He opened a commission-free brokerage account, set up a regular transfer, and bought broad market index funds every other Friday. Denise could not shake her fascination with property. While Grant pressed buy buttons, she toured duplexes on weekends and attended city zoning meetings. Their choices seemed worlds apart, but both shared one question that high-interest searches echo today. Should I buy an investment property or keep my savings in the market? Through their mid-20s, Grant and Denise watched headlines swing. The pandemic roller coaster sent stock valuations tumbling, then soaring. Grant's index fund fell by more than 1/4 in a single spring week, only to rebound by almost 1/3 within 7 months. Denise saw something different. Her first duplex, purchased with a 20% down payment and a fixed mortgage rate just below 4%, never missed a rent check. In fact, remote workers fleeing dense metros filled her units at higher rates than expected. She refinanced once rates touched 3%, trimming her monthly payment and freeing cash flow for repairs. Here we meet the first core difference: market liquidity versus income stability. Equity investors like Grant gain the comfort of instant liquidity, yet face short-term volatility. Rental owners like Denise accept illiquidity, but often benefit from steadier checks that arrive, whether headlines shout or whisper. By 2025, both friends agreed to calculate total returns with the objectivity of engineers. Grant tallied dividends plus price appreciation. Over 6 years, his index fund grew at an annualized pace near 9%, close to historical norms. Dividends reinvested accounted for a little more than 1/5 of that growth. Denise opened her bookkeeping software and found something interesting. Her rental cash flow averaged 6% of her initial equity each year after expenses. Appreciation ran about 4% annually in her suburban market. Combined, her unleveraged total return appeared similar to Grant's, yet leverage changed the math. With a 5-to-1 loan-to-equity ratio, that 4% appreciation translated to 20% growth on her cash invested. Even after subtracting mortgage interest, she was compounding closer to 13% a year. Grant counted that his equity portfolio required no phone calls to plumbers at dawn. Denise admitted that property management consumed time and carried risk, which is why buying property cash versus mortgage debates trend online. She explained that all cash buyers avoid leverage risk but cap upside, whereas a prudent mortgage magnifies gains while letting tenants repay principal. She devoted part of each rental payment to an emergency reserve and bought parametric insurance that automatically pays if wind speeds exceed a threshold. By pairing new risk transfer tools with traditional reserves, she slept well on stormy nights. Tax season widened the gap. Grant paid long-term capital gains rates on stock profits equal to roughly 15%. Denise filed her Schedule E, deducting interest, property taxes, repairs, and a generous 27.5-year depreciation allowance. Her accountant also ran a cost segregation study that front-loaded write-offs on flooring and fixtures. The paper losses offset nearly half her rental income, cutting her effective tax rate below 10%. That is why searches for return on investment in real estate often spike in early April. The friends then examined risk. Grant scrolled through a chart showing that major equity indices suffered 5 drawdowns greater than 10% in the previous decade. Denise studied county tax rolls and saw home prices in her neighborhood had fallen only once in 15 years, by less than 5% during a mini tech sector exodus. She did note that other regions saw sharper housing drops, reminding her that real estate is local and that comparative market analysis real estate remains essential. 2025 brought new wrinkles. Artificial intelligence trading algorithms now scan social sentiment and corporate filings faster than any human, occasionally amplifying market swings. Meanwhile, fractional real estate platforms allow investors to buy $1,000 slices of an apartment building, merging stock-like liquidity with property returns. Searches for arrived real estate investing review illustrate curiosity about these platforms. Grant and Denise each allocated smaller sums to such fractions, enjoying quick diversification without the headache of closing costs. Interest rates hover near 6% for 30-year mortgages this year, a far cry from the 3% loans of early decade days. That shift compresses rental cash flow and slows price growth, yet it also dampens new construction, tightening supply in many cities. At the same time, corporate profits fuel steady dividend hikes, even as artificial intelligence spending inflates capital expenditures. So where does that leave our comparison? Grant and Denise collaborated on a simple forecasting model. They assumed stock market total returns might average 8% over the next decade, built from 5% price appreciation and 3% dividends. They projected leveraged rental returns in balanced markets at 10 to 12%, built from 6% cash flow after expenses and 4% appreciation multiplied by leverage effects. They also modeled worst-case scenarios. If equity markets fell by 20% in year one, Grant would need 2 full years of 8% gains to claw back nominal value. If rental vacancies spiked to 20% and appreciation stalled to zero, Denise's return could plunge to nickels on the dollar but would likely remain positive so long as rents covered mortgage interest. So how much return to expect from stock market or real estate? In 2025, the answer is a range, not a single figure. Stocks offer high liquidity and global diversification, making 8% per year plausible, but braced by volatility that punishes panic sellers. Real estate offers tax-favored cash flow and leverage that can push returns into the low double digits, but at the price of effort, financing risk, and illiquidity. For listeners pondering, why should we invest in stock market or whether real estate is the best investment, consider this framework. First, map your time horizon. If you need funds in under 3 years, market exposure through liquid ETFs may fit better than property. Second, assess your tolerance for phone calls about broken dishwashers or zoning hearings. If that evokes dread, a real estate investment trust might deliver property-like returns with less toil. Third, study taxes. High-income professionals often benefit from depreciation and cost segregation, while lower brackets may simply prefer pass-through qualified dividends. Finally, diversify across both asset classes when possible. Grant has since added a small rental via a fractional platform that yields quarterly dividends linked to rent collections. Denise opened a health savings account invested in low-cost index funds for medical expenses. Each adopted the other's strategy without abandoning their original strengths. By weaving together equity growth and property cash flow, you create ballast against the unknowns of 2025, shifting Fed policy, climate risk, and the ever-expanding role of artificial intelligence. The debate between stock market versus real estate returns is not a fistfight with a single victor, but a partnership in which each asset dances to a different rhythm. That wraps our exploration of comparative returns. If this episode helped clarify your investment compass, subscribe and share the property code. Until next time, stay strategic and keep building your financial foundation.